Well, let me tell you what my hope is. I'm going to be talking about something that I think is extremely important to the first-time investor who has not, in fact, come to some sort of an agreement about what their lifetime strategy is going to be. Let's not forget that almost everybody in the industry says that the key commitment is to be able to stay the course. So whether you put all of your money in cryptocurrency, or you put all your money in NVIDIA, or you put all of your money in a target date fund, my hope for that first time investor is they're going to find a solution that they truly can live with for the rest of their life. Now, I know that's a big dream. And why is it a big dream? It's because I know whatever you do, to the extent that it's different than what Merrill Lynch wants you to do, or Goldman Sachs wants you to do, or Vanguard wants, whoever, that they want you to change to something they think is better. And of course, nobody knows what's better, but I can say this, that the probabilities of long-term success for the first-time investor is far better if they truly understand the ride they are about to go through. Because in theory, the first-time investor is talking about potentially 50, 60, 70, even 80 years of investing experience to face. And how can I, at age 81, sit here and tell you what the market's going to be like even 20 years from now? Well, the only hope I have is to be able to look back and see if there is information that seems realistic about the past. We don't want to be Pollyannish about this. We know it is not an easy ride. The stay the course ride is going to test most investors. And I want you to be hardened, ready for that. But I also want you to be in a strategy that has the probability of giving you a very fine return for the rest of your life. Now, that's the one group. And I know what's going to happen. We're going to put this up on YouTube. We're going to put it up as a podcast. And 2 to 10,000 people will either see it or hear it. But my hope is that some percentage, and I know it's a small percentage, this is the first time you've seen this kind of information. And you find it respectable, reasonable. Like I'm not making claims that are unrealistic. Now, there's another group out there that I think is this information is equally as important to, and that's the group that is coming up on retirement. And they have to decide, for example, they might be a target date fund investor, and should they be adding a little bit of small cap value to their portfolio? Should they, instead of having the S&P 500 only, have all four of the major U.S. equity asset classes? We know that as you see other parts of this Bootcamp series, and this actually was not designed to be a part of the Bootcamp series, but I'm probably going to sneak it in there some way because I think this information, while it is not up to date, I'll explain why in just a second, that this is as important as the fine-tuning tables or the distribution tables or the accumulation tables. So let me talk about what this is and also what it isn't. I already told the story on it's not up to date. This is information that is through the end of 2022. By the way, that doesn't mean anything different because nothing has happened since 2022 that would change these numbers significantly. Maybe a teeny tiny bit. And you'll see why in just a second. And the other part is it's hard to know how real the past is in terms of preparing for the future. I would have said 10 years ago that I could define the course the United States is on. We were on a path to something that looked like what I had grown up learning America is supposed to be. I'm not sure that's the case right now. I really am not sure. And I don't think it matters which party you come from, whether you lean right or left or right in the middle. I don't think people know. And so maybe there's something going on that we could say that the past doesn't matter, but the past does happen to include world wars of sorts. Well, at least one world war, if you go back to 1928, and our numbers do go back then to then, but other smaller conflicts, but that were still important wars, and a depression, and failed economic times when there were serious recessions, political upheaval. I mean, the story about the past is probably very similar to the story about the future, but we do not know what PE ratio, price to earnings ratio, they're going to put on earnings. There are companies right now selling for 100, 200 times earnings that 5 years from now could be selling for 10 times earnings, even though their returns, their earnings went up. We don't know. So, this information I'm going to share with you is to help give it perspective. And that means, as far as I'm concerned, that we need to focus in on the parts that are hard to take and the parts that are easy to take. The hard to take ones are the periods when things aren't doing as expected, as desired, as wished. And then the other side of the coin, when the market just lays it out there on a platter and gives you returns you just had no expectations were going to happen. I am sure in 1975 that very few people would have ever guessed that for the next 25 years, the major market index would have compounded at 17% plus. And why do I believe that? Is because most people in 1975 who had money had some remembrance, some memory of what happened during the Depression when the market was absolutely terrible. And in fact, was even a famous cover of a magazine. I think it was U.S. News and World Report. And on the front cover, it said, "The Death of Equities." And that was, I believe, in 1978 that issue came out because people were really concerned the stock market had the ride was over. No, the ride was just getting started. And by the way, that was true for large companies that are growth oriented, small companies that are growth and value oriented. Everything did quite okay. I think during that period that the S&P 500 compounded at 17, the small cap value index, as reported by Doctors Fama and French, had about a 22% compound rate of return. Problem is, nobody knew about the small cap premium at that point, which is what makes this information kind of it's easy to question because for so much of the information, and we're going back to 1928 in these studies, and some of you have seen these before, and hopefully I'll give you some new information if you have seen them before. But but there is the big question. How meaningful is that information from the past? But I want to remind you, and I'll talk a little bit about this. I want to remind you that 1928, I'm sorry, 29 to 38 had almost exactly the same 10-year return as from 2000 through 2009. Now, how they got there was different. It was much more volatile, the market was from 1929 to 38. For one reason, because not very many people were in the market. The market was not as liquid as it is today. Only, I think, at the time of the crash in 1929 and 30, that only about 10% of Americans had ownership of public stocks. And I can tell you that the Depression didn't encourage people to do a lot more investing. In fact, what we know is either people didn't have money to invest or that was a wake-up call, what the market did, and they didn't want to have any part of that. As a matter of fact, you have to go into the 1960s until people who had been scared out of the market during the Depression were willing to come back in. It was hard for people to come back in the market because the memory was so vivid of what had happened before. And it's one of those things that makes it difficult for people to stay the course. So here I'm going to move forward. And as this cover page says, this is a story about four portfolios, equity portfolios. One will be a buy and hold on the S&P 500. One will be a buy and hold on small cap value. I'm not saying you should put all your money in either one of those. I do know a lot of people put all their money in the S&P 500 as their equity exposure. Very few choose small cap value as their only equity exposure. And if we look to the past, there's enough scary times that I think that's probably a good decision. Even when my wife and I gave our granddaughter money to fund her right after she was born, to fund her Roth IRA when she earns enough to be able to do it. We split that money half between large cap blend and small cap value. We really want the history that she learns about when she's 18 to look in a way that she will say, yeah, I could stay the course with that kind of an investment. So let's look at the first of these tables. There are four of them. And the first thing I want to point out is what we've got here. And this, again, is almost always with these kind of tables. This is the work of Darrell Balls. And remember, I said it ended in 2022. It started in 1928. And Darrell looked at the 1, 2-year return, 3 years, took all of the 1-year returns and did the calculation, made them all 2 years, 3 years, 5, 10, 15, 20, 25, 30, 35, and 40. And the reason he did that is because you're going to see some patterns that are very, very important in understanding what the future could look like. And if you're an optimist, like so many investors are, you just don't spend a lot of time looking at the downside, but the goal here is to give you both sides of that teeter-totter. What it's like when your side's going down and what it's like when your side's going up. So as I look at the S&P 500, what do I know about this index? Well, the first thing I know about this index is that it wasn't a real index that anybody covered specifically until 1957. So everything before 1957 is hypothetical. Now, what the academics have done is to recreate what they think the S&P 500 would have looked like. And remember, the S&P 500, those stocks are chosen by a committee. So now you're second guessing a committee. But because there are so many companies in the index, I suspect that the return is a fairly legitimate representation. And the first thing that we look at here, not just the time period on the far left, but the range of annualized returns. Annualized, whether it's 1 year, 2, 3, all the way through 40 years. So you can see the very best and you can see the very worst. Now, these are calendar years. That's very important because as I look, for example, at the range of annualized returns for the S&P 500, the worst calendar year was a loss of 43.3%, including the time from 1929 to 38. Now, that is the worst calendar year. If we looked at 12-month periods so that every new month is starting a 12-month period, or even better yet, we simply looked at some point in time, the market stops going up and starts going down. And by the time it reaches its bottom, what they call a drawdown, and then comes back up to where it started, that amount, for example, in the 2000 through 2009 period, 2 times the S&P 500 lost 50% or more. So, in fact, this study does not represent the worst of times. So, it's looking at calendar years. That's important. So, what do I know when I see 1 year at a time? Well, when I see 1 year at a time, if I just looked at the average CAGR, compound annualized growth rate, in the third column over, you'll see that the average 1 year return was 11.8%. Now, when I say that, I want to apologize for all the times I've yelled and screamed that one of our competitors, another teachers whose work I do not respect, he will make the case that the average return for the S&P 500 is 12%. The problem with that is when you look at pure averages, that the impact of losing is not as great as the impact when we compound the return rather than looking at average returns. So if you have an investment that you put $100 in and it goes up 50%, the first year it goes to 150, and the second year it goes down 50%, it goes down to 75. And yet the average return was 0. So average returns overstate the compounding return that you're likely to experience. But for the sake of consistency, Daryl has kept it the average CAGR for all of the different periods. By the time you get out to 40 years, it's a pretty good number. But that's a long time for most investors to be thinking. Here's what I know. I know that for the 1 year at a time, that range is from a minus 43.3 to a plus 54. Now, when people are asked, what do you think? And I'm talking about experts. What do you think the market's going to do next year? Most people come in and around the 10%. We'll use what the compound rate of return has been. If they're a little more aggressive, maybe they'll use 12%. But they're rarely calling for big ups or big downs. From my viewpoint, the reality is, from what I know about the past, that you could lose 40 to 50% of your money next year. Nobody knows what the next year will bring. And you could have a year you're up over 50. It happens. And you're going to see that with each one of these either individual equity asset classes, or you're going to see it as a combo of several. So you can see here that Daryl looked at 95 separate one-year periods. And out of that, 26 of them were losing years, which basically tells me that I've got to be ready. In fact, that translates into 27.4% of all the years were losing years, but about 1 out of 4 years, I should expect to lose money. It could be a lot, it could be a little. But that's an important thing to know, because if life looks like historical averages, it's a little uncomfortable to know you're very likely to lose. And by the way, a fairly substantial amount of money. Even when you look at all 2 year periods. Now, keep in mind, when we go to looking at 2 year periods, that would include 28 and 29. It would include 29 and 30, 30 and 31, 31 and 32. You are repeating some of the past history when you do that. And so it is always statistically more meaningful, I'm told. I'm not a statistician. I'm a student and a teacher of what I've learned from others, and they say it's better not to have these overlapping periods. Let them stand on their own. Well, in this particular study, Daryl has shown whether it's the 2, the 3, the 5, you're going to pick up something from the past in your return. By the way, that does mean those terrible, terrible years back in the early 30s, uh, they are in essence out of the way fairly early in calculating these averages. So if they had come in the middle of this 95-year period, then it would have had a greater impact. But that's just one of the things we need to understand. Anyway, what I see here is you have to go all the way out to 10 years and look at the rolling 10 years, and you are still historically experienced a 10-year period that you lost 1.4%. And as a matter of fact, if we go all the way over to the right, you'll see there were 4 10-year periods that the S&P 500 lost money. Now, I am sure some of that is a matter of overlapping periods. But that does mean that it is not impossible to put your money in today and 10 years from now, the value of that money, not even taking into consideration inflation, the value of that money has gone down. And that's what people found out from 2000 to 2009. It happens. And that is why one needs to, when they go from working to retirement, And depending on their investments in retirement, a lot of people are going to for sure have some fixed income there to protect against the downtimes. But then when I look beyond 10 years and look at the 15-year periods and the 20 and the all the way to 40, all of those were periods that there were no losses when you looked out 15 years. Now, having said that, remember I said inflation is not considered here. So when I look at the worst 15-year period for the S&P 500, I want you to notice that there was a period that the compound rate of return for the 15 years was a gain of 0.6% a year. But when I'm talking on May 29th to the seniors at Western Washington University, they should not be worrying about those early years being bad. And in fact, I'll show you in just a second how some of the worst years in history could be on your side, on your side. So this you'll notice, once you get out beyond, actually, if you look at the average CAGR for 2 years through 40 years, it's almost the same for every period, the average. But the range for 40 years, and this is important to those seniors, for the S&P 500 was a compound rate of return, the worst 40 years of 8.9% and the best 12.5. And let's remember, every extra half of 1% could be worth another $1 to $2 million once you're in retirement and over your retirement and what you leave to others. So I would love for you to experience the 12.5 rather than the 8.9. Now, you'll also notice that as you start at the top, the very best return for a year was 54%. When you go to 2 years, it drops down to 41.7. When it's 3 years, 31.2. When it's 5 years, 28.6. These are the compounded annualized returns. And then 20.1, and it keeps going down and down and down. So at 40 years, the very best 40-year compound rate of return was 12.5. So it will matter when the good and bad times come, and you'll see that in just a few minutes. But my hope is that this gives you a real view of what could happen to you as a young investor. You could start out and things don't do well for an extended period of time. In fact, let's look at small cap value. Small cap value is an asset class that instead of the company's billion being worth over 100 billion, many of them over 200 billion, many of them over 500 billion dollars, instead small cap value is companies, they are companies that are 3 to 6 billion dollars in capitalization. That means if you multiply the dollar, the market value times the number of shares, that will tell you what the public thinks that company is worth. These are small companies, and these are companies that are out of favor, sell for lower PE ratios, as an example, than the more popular growth small companies. But I want you to see it, and we're going to have an easy way to compare all these numbers in a few minutes. We're going to see that Small cap value, if you remember, the worst year with the S&P 500 was a loss of 43.3. No, now it's 55.4. But before, the best year with the S&P 500 was up 54%. Now it's 124.7 for small cap value. Huge differences 1 year at a time. And if we go out to the 10-year, remember, at 10 years, the S&P 500 had a 10-year period. The worst one was a loss of 1.4% a year for 10 years. For the small cap value, it's 7.1%. And in fact, I've got this here somewhere. Yeah, if you lose money at a rate of 7.1% a year over 10 years, that compounds down to a loss of about 52%. That's a big loss. And in fact, if you invested in the small cap value, if you put in $1,000 at the beginning of that period, which would have been, by the way, 1929, from 1929 to 1938, your $1,000 investment would be worth about $480. And so that's not a good return. And you can see that that means it is much more risky than the S&P 500. Now, I'll tell you why I think this is important to point out. In the Sound Investing portfolio page that we talked about several weeks ago, and I'll make sure we have, if you haven't seen that conversation with Daryl and Chris and myself, you would see that the S&P 500 and small cap value had about the same losses from the period of 1970 through 2024. But here you can see significant more risk in the small cap value. Now, this is a tricky business. This could be really important to me if I just held small cap value. Because at age 81, that means that I'm setting myself up for the potential of losing over half of my life savings. That would be like going through a divorce, okay? At age 81, another 50-50 split. That is huge risk, which is why my wife and I have about half our money in bonds, and half our money in stocks, and half our money in large, and half our money in small, and half our money in growth-oriented blend, half our money in value, half our money in U.S., half our money in international. We are massively diversified because we're not so concerned about how much we make, but we want to be sensitive to how much we lose. But for a young investor, it could be a different story. And I want to talk about that for just a second because I did the numbers. I looked at the period from 1929 to 1938, that period that represents the worst for the S&P 500 and the worst for small cap value. And here's what I found out. I already told you that $1,000 shrunk to $48 over that 10-year period in small cap value. On the other hand, if you had taken that $1,000 and dollar cost averaged into small cap value over that 10-year period, even though there were 6 losing years, and the 6 losing years, the average loss was 34%, okay? Even though you had these huge losses. There were also some good years. There were 4 years that the returns were good. It was a very volatile period. Remember, not many people were in small cap values. The markets were not very liquid, so it's very different than today. But that doesn't mean you couldn't still have those losses. But here's the bottom line. If you had invested $100 a year over those 10 years, you would have actually made per year a 9.1% gain. You go from a loss of 52% to a total loss, or a loss of 7.1% a year. You go to a loss, a gain, I'm sorry, of over 9%. And that's the magic of starting out in the bad years. And I might just comment that if you looked at the next 30 years, after you only made 9.1% for the first 10 years, for the next 30 years, small cap value compounded at over 19%. And remember, that's not a miracle because the S&P 500 has compounded for very long periods, as we know, at over 17. And small cap value is more risky. We see it here. And in fact, you'll notice that you have to go out 20 years before you're historically guaranteed a profit. And by the time you get out to 40 years, the range is from 11.6, the worst, instead of 8.9, as it was for the S&P 500, to the best of 19.1. And the average CAGR, compound annualized growth rate, you'll see is around 15%. Now, we know that it hasn't made 15% over the last 55 years. We know that because we track it. I think it was 13.3, if I'm not mistaken. You'll see that in the sound investing. So it did not do as well, but also small cap value is now something that more people know about, and people believe that once more people know about it, that the returns go down. And that might be true of the S&P 500 as well. But you know that if you've been around for a while, that we absolutely believe in diversifying away from just the S&P 500. We don't mean that owning the S&P 500 for the rest of your life is likely to be a bad investment. Don't mean that at all. I think it'll be a very fine investment. But I do know this, that a portfolio that's half in the S&P 500 and half in small cap value, which is what this two-fund strategy is, has a very fine compound rate of return with remarkably similar kinds of risk exposure as you would get in the S&P 500. Now, those of you who have seen the quilt charts, and the quilt charts for this year are not out yet, coming soon. Can't wait for it. I love talking about the quilt charts. But what I do know here through 2022, that the profitability after you get out to 15 years with the two-fund strategy, by the way, notice because half of the money is in small cap value that you still have some losses here at the end of 10 years. And here at 15 years, we finally get profitable. And by the time we get out to 40 years, it's a range of 10.8 to 16. But there is no question, it's still a slightly bumpier ride. And we'll be able to compare that in just a second. But what I want you to notice, and let's just look over here at the years where there were losses. You start at with 1 year, 27 years are losses. And it goes down to 15 when you add a second year, and it goes down to 13 when you add a third year. And then if you look at all the 5 year periods, there's only 7 losing periods. When you go out to 10, there are 3 losing periods. And by the time you go out to 14, 15 years, there are no losing periods. Now, if we were to include inflation, I would tell you that those 15 years that you made 0.3% would not have been enough to protect you against inflation. But when we compare the two fund strategy, just remember all those 13.9s and 13.5 and 2. When we go to the four fund strategy, notice you got a whole bunch of 13.8s and a 13.3 and a 13.1. I mean, it looks very, very similar. The worst 10 years instead of 3.3 is a minus 2.8. So it's starting to look more like the S&P 500 because you have now included some large cap value along with the S&P 500 and some small cap blend and some small cap value. And the return difference over the long term will likely be somewhere between 1/10 of 1% and probably 3/10 of 1% compared to the two fund strategy. Now, I know I had a written communication from Daryl. I know what Daryl would be saying here today. He would say that he would give the nod to the two fund strategy because it's easier to manage. I would say I'm okay with either. The thing about the four fund strategy is that you do have additional diversification. And the reason you see slightly lower returns is because you do have that additional. And you'll see that in when you see the quilt charts, if you haven't seen them before, where we look at every year and we see very vividly what equity asset classes are the best and the worst 1 year at a time, going back to 1928. But there are a lot of years that the S&P 500 and small cap blend are at the top of the four different equity outcomes. You'll hear more about that in the coming weeks when I get my hands on that quilt chart. So let's just look at this final slide because we can look so easily at the differences. You'll notice the S&P 500 has one yellow year. That's returns under a negative 10%. So it is lower risk. You get to lower losses quicker with the S&P 500 than you do the others. You can also see that the returns for the S&P 500 are anywhere from, depending on what period of time you're looking at, from 2 to 3%. And we know that's a big deal over a long period of time. And the risk, particularly after you get out to that 15-year period, the risks are very similar. In fact, once you get to 20 years, you'll notice that at 20 years, the worst period for the S&P 500 was a gain of 3.1. For small cap value, a gain of 4.4. For For the two fund strategy, a gain of 4.3. For the four fund strategy, a gain of 4.4. In fact, it is remarkable after you get out to longer periods of time how close the two fund and the four fund strategies are. So my sense is for the long term that the two or four fund strategies should be good. For somebody who's in retirement and maybe don't have 40 years, maybe have 10 or 20 years, I might go with the four fund strategy to give myself more diversification. But the bottom line here to me is in terms of our education as a group, I have to deal with this with our portfolios too. It's the same question. How much risk am I willing to take? And typically, when we think of risk, loss is what comes to the top of the list. Some people say the biggest risk of all is not taking any. Just the complete opposite side of it's about loss. Because if you don't get the premiums over a long period of time, having some equities in your portfolio, you're not likely to have enough money to live on in retirement unless you make a drastic change in your lifestyle. Even if you only put in 30 or 40% equity, it makes a huge difference. And we'll talk about that when we get into distributions in the coming weeks. Now, I certainly welcome any questions that you have. We did not include the all value portfolio here. We didn't include the worldwide because we don't have numbers going back to 1928. But I think that if we had worldwide, they wouldn't be so dissimilar from what you see here. And if we go back to 1970, the returns of worldwide and US only are very similar. So I hope this is helpful. Oh, do I hope it's helpful for young people so that you won't be afraid of the big bear market. And to those of us in retirement and people like me deep in retirement, that we don't take too much risk. And if we're going to have small cap value, we limit that as to how far we go with that. But for a lot of us, we're investing a good portion of what we have for those who survive us. And for those of us who build portfolios to take into consideration those who survive us, more small cap value is probably okay. So thank you for watching or listening. Share this with you, by the way, those who are listening to a podcast, you're going to have links to these tables in the podcast notes, as well as as a link to the sound investing discussion that Daryl and Chris and I had. And I hope you'll stick around over the weeks for more of these boot camp presentations. We think they are very important and will make you a stronger, better educated investor for the long term. That's our wish. Thank you.